The $100 barrier is already broken. Crude oil has once again crossed the $100 per barrel threshold, a level that once seemed like a relic of the early 2000s commodity supercycle. But this time, analysts across Wall Street and beyond are floating a number that would have seemed absurd just 18 months ago: $200 per barrel. Before you dismiss that figure as sensationalism, keep in mind that the conditions driving today's oil market are unlike anything we have seen in the modern era of energy trading. Three distinct forces: geopolitical disruption, structural underinvestment, and surging emerging market demand, are converging simultaneously, and the resulting mathematical reality is quite uncomfortable. In this article, we break down each of those forces in detail, explain what a $200 oil environment would actually look like across different sectors and markets of the global economy, and, most importantly, walk you through actionable strategies to protect your portfolio and potentially profit from this highly volatile landscape. The geopolitical premium is real and growing. The Strait of Hormuz is the world's most important oil transit chokepoint, with approximately 21 million barrels of crude passing through its narrow waters every single day. Any meaningful disruption to that flow, whether through direct military conflict, naval blockades, or retaliatory strikes on shipping infrastructure, sends an immediate and massive shock through global energy markets. Recent escalations in the Middle East have reintroduced what traders call the geopolitical premium into the price of every liter of crude oil. And unlike previous episodes, there is no clear diplomatic off-ramp currently in sight. Historically, geopolitical risk premiums in oil tend to be transient. Markets price in a worst-case scenario, diplomacy intervenes, and prices normalize. However, the current environment is different because the risk is not a single point of contention. It is a sustained multi-factor standoff with supply chain implications that extend well beyond the Persian Gulf. Refineries in Europe and Asia, which depend heavily on Middle Eastern crude, are already scrambling to diversify their sourcing. This is driving up freight costs and creating secondary ripple effects across the entire energy complex. A decade of underinvestment is catching up. Between 2014 and 2020, the global oil industry slashed capital expenditure by more than 40% in response to a prolonged price collapse. ESG pressures, shareholder activism demanding returns over growth, and the widespread expectation that peak oil demand was imminent all conspired to keep investment low, even as prices recovered in the early 2020s. The result is a structural supply deficit that cannot be resolved quickly. New oil fields take 5 to 10 years from exploration to first production. The pipelines of projects that would normally be coming online today were canceled or deferred years ago. This structural undercapacity means that even if geopolitical tensions were to end tomorrow, the supply response to high prices would be slow and very limited. OPEC Plus nations, many of whom are operating near their stated capacity ceilings, have limited room to compensate. U.S. shale production, once the great swing producer of global markets, faces its own headwinds. Rising break-even costs, labor shortages, and investor pressure to maintain discipline rather than chase volume. Demand is not slowing down. While Western economies have made meaningful progress in electrifying their vehicle fleets and reducing industrial oil consumption, the global picture looks very different when you zoom out. India, Southeast Asia, and Sub-Saharan Africa are still in the middle of their own industrial revolutions, with rapidly expanding middle classes that are buying their first cars, building new infrastructure, and consuming energy at accelerating rates. The International Energy Agency has repeatedly revised its demand forecasts upward, acknowledging that the energy transition in advanced economies is being more than offset by demand growth in the developing world. Aviation and petrochemicals, two sectors for which there are no near-term substitutes for oil, continue to show robust demand growth globally. Jet fuel consumption in particular is running well ahead of pre-pandemic levels as international travel returns to normal. These persistent demand drivers, combined with the constrained supply environment, create the conditions in which extreme price scenarios become not just possible, but probable. What $200 oil means for different asset classes. Not all parts of your portfolio will react the same way to a sustained oil price spike. Energy stocks, particularly integrated majors like ExxonMobil, Shell, and Total Energies, are the most direct beneficiaries. Their earnings are highly leveraged to the price of crude, and at $150 to $200 per barrel, their free cash flow generation becomes extraordinary. Energy ETFs such as XLE and IXC offer diversified profit potential without single stock risk. On the losing side, airlines, consumer discretionary companies, and any business with significant logistics and transportation costs will face severe margin compression. High oil prices act as a regressive tax on the entire economy. They raise input costs across manufacturing, agriculture, and retail, while simultaneously squeezing consumer purchasing power. Bond markets are also vulnerable. Persistent oil-driven inflation complicates central bank policy and could force interest rates higher for longer, putting downward pressure on fixed income assets. Portfolio strategies for a $200 oil environment. Investors looking to navigate this environment should consider a multi-pronged approach. First, a direct investment in energy equities or commodity-focused ETFs provides the most straightforward hedge. Second, broad commodity exposure through instruments like DJP or GSG provides a diversified inflation buffer. Third, gold, the classic safe haven asset, tends to perform well in environments where energy-driven inflation is eroding real returns, making it a complementary holding. Beyond direct hedges, investors should review the energy intensity within their existing equity holdings. Companies with pricing power and low energy cost risk, certain technology firms, healthcare providers, and utilities with renewable generation tend to be relatively resilient in high oil environments. Reducing the weight of investments in capital-intensive industrials and consumer-facing businesses with thin margins is also a prudent approach. Prepare. Don't panic. A $200 oil scenario is not inevitable, but the conditions that could produce it are real, present, and intensifying. The investors who will fare best are not those who predict the exact price level or timing. No one can do that reliably. But those who have built resilient portfolios enough to withstand extreme scenarios in either direction. That means holding some energy investment as a hedge, maintaining diversification across asset classes, and avoiding concentrated bets on sectors that are most vulnerable to a sustained price shock. The oil market has a long history of surprising even its most sophisticated participants. The best preparation is not prediction, it is positioning correctly. Review your risks, understand the second-order effects across your holdings, and make sure your portfolio is built for a world where $100 oil is the floor, not the ceiling. Please don't forget to like the video and subscribe.